Hello again, this is Greg Donaldson, and I wanted to give you another update on corporate earnings. Before I do that, I wanted to acknowledge what is on everyone's mind and what we've been reading in the papers and on the internet and on television as it relates to the financial markets is that the markets have been in just a very sour mood really since about the end of April. And I will not hit every item here, but basically it sort of started with some worries that perhaps China may, the economic growth in China may slow down. Our view in that case was that it probably needs to slow down from the 9% pace to some lower level, and we were not worried about that. The next thing that reared its head was the sovereign debt crisis in Europe and the problems with the debt in Greece and in Portugal and to a lesser extent in Spain. And the package, the bailout package that the European Parliament passed, we feel as though is substantial enough that ultimately it is going to buy enough time that Europe is going to be able to get its financial house in much better order than it was, and we do not see that sovereign debt crisis spilling over to the United States. Then we had worries about the oil spill and the fact that it was going to shut down the economy or kick oil prices through the roof, and our view is a little colored there by the Katrina, when we realized that Louisiana and that part of the country is very important, but in terms of the GDP of the whole country, it's rather small, and the oil crisis or the oil spill would not produce a crisis that would take our economy down. But there seems to be a new thing to worry about every week, and subsequently what has happened is that the good news in the area of corporate America, and really for that matter the world, on earnings has largely been ignored. And even last week when I did this audio blog, the market had gotten crunched and earnings had started off with really some sensational results. And I said this would be a big week, and it has been, and I identified a number of companies. And I want to say to you that Caterpillar, I think, was a key earnings indicator. They beat earnings by 30+% and talked about business around the world. Business is good everywhere. They've started added employees. They're spending money on capital, and I think that gives us a pretty good picture of the world economy. Because Caterpillar derives so much of their business, nearly 65% of their businesses around the world. Then Wells Fargo reported and had a very solid report. Banks are very complex in their earnings announcements, but we thought Wells Fargo's was as clean as it probably is possible to make a bank earnings report. They beat the estimates by a wide margin, and something that was probably more important than anything is the quote by the chief financial officer of Wells Fargo when he said, "We believe the credit quality has indeed turned the corner." That is a mouthful. So let me give you the results for the week. We've now had 149 of the 500 companies in the S&P report. The average earnings growth over a year ago is 60%. That's a big number. The average surprise over the estimates is 12.5%, and there have been 126 positive surprises and only 22 negative surprises. On the sales front, which is really where everybody is worried about, on the sales front, sales for companies reporting have grown by about 9.25%. That's very healthy. There have been 102 positive surprises and 46 negative surprises, and sales are probably even better than what we expected here. We expected earnings to be good, but we did not expect sales to be this good. And I think this is a clear sign that at least for corporate America, things are getting a lot better. Now remember this, and I'll close in just a moment, but remember this. In the Standard & Poor's 500, about 50% of the revenues come from outside the United States. And what is not well known to most Americans is that worldwide economic growth in 2009 and 2010 will be higher than the growth in the United States. Now, finally, the market seems to be waking up to the reality that maybe everything isn't going to swirl down a sinkhole. Maybe, just maybe, the market is starting to realize that these earnings are for real, the revenues are for real, and not only are they good now, but they're going to continue to be good. And indeed, the Wall Street analysts are now estimating that 2011 earnings are going to be up another 15%. Stocks are incredibly cheap by historical standards, and interest rates are remarkably low, and maybe, just maybe, people may come to the conclusion that getting a 3% dividend yield on Procter & Gamble with the potential for something in the range of maybe 9% growth over the next several years might be better than buying a 3% U.S. Treasury bond. We believe that's the case, and we think by evidence of the market yesterday when it was up over 200 points on the Dow, and as I speak we're up almost 100 today on Friday, we think the market may be kind of swinging around to our point of view. So thank you again for listening. The news continues to be good. We'll report again next week. Have a good weekend and see you soon.